Now let's take a look at the opposite of this theory. Remember in the prior video we were talking about high volume or high activity coming in on the turns. As we can see here, I know two examples don't exactly equate to a surefire theory, but I'm sure as you go and look through your own charts, you'll see that when the market turns, and of course this is not something you can predict, it's simply something you can observe. When the market turns, you will see that it occurs on high volume up and down bars. Here and again here. Now, when we're talking about low volume, if high volume is important, what about low volume? Well, there are specific areas where we are going to be concerned with a drop in activity. So it's important, again, in the spirit of accurate thinking, that we are, again, specific about what do we mean by low volume, and even for that matter, what do we mean by high volume. It's better said that we're talking about relative volume. You can see in this particular area of activity that there's almost a bell curve of different price bars. You can see that here we had some low bars, the market came up, forms a peak, and then starts to come back down, eventually just dropping off. Now, of course, if you've taken any kind of math, you have been at least exposed to the bell curve. Now, the bell curve supposedly will identify the areas of the average and also the extremes. Now, we're not going to be concerned with trying to form a bell curve, and don't worry, I'm not going to get into calculus. I didn't like it that much either. But what we can do is observe and look at what relative volume is. Now you can see that in this area of the chart that there was this area of volume. You can see that in this area, volume has a certain height. Now when we compare that volume to prior areas on the chart, such as here and here, we can see now that relatively speaking, the area is low. Now, if we simply zoomed in to where those volume bars took up the charts, now we have a completely different picture, don't we? We're still looking at the low volume area that we had been observing before, but now we're looking at the low volume in comparison with itself. So all we have on a relative basis are this extreme, and this extreme. And since we're looking at this extreme zoomed in view, we now have a complete redefinition of relative volume, don't we? We also have a new definition of activity itself. So, what the heck does all that mean? That means you've always got to compare volume to other trading areas. You never want to get so fixated on a certain area of the chart that you start calling something high volume or low volume without perspective. Now, for most of us, this will come into play when we change the time on our bars. For example, you wouldn't want to look at, for a sake of argument, a 5-minute bar, as you can see here, see one specific spike, and now consider that this 1 5-minute bar is the high volume. You always want to verify that, both with the time period itself, comparing it to other areas on the chart,